Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. In the previous lesson we learnt about the account opening and transactional workflow of Ethereum. In this lesson, we will complete the discussion on the transactional workflow by learning how transactional fulfillment occurs on Ethereum. We will learn about the concept of transaction fee sufficiency. We will also cover new coin issuance, the concept of uncle blocks and block gas limits. So far, we have covered the initiation and authentication phase of the transactional workflow of Ethereum. In this lesson, we will cover the transaction fulfillment step. Before we proceed further, let us take a minute to reflect on what occurs in this step. Before this step, the official blockchain record is in a particular state. Let's call this state A. After this step, the official blockchain record is in a new state. Let's call this state B. All the nodes in the blockchain move from state A to state B. Next, we will explore what is the difference between state A and state B. In Bitcoin, the difference between the old state and new state lies in new crypto payment transaction records tied to different Bitcoin addresses. In Ethereum, the difference between the old and the new state can be one of four things. First, new crypto payment transaction records. This is identical to Bitcoin. Second, change in the Ether account balance. Unlike Bitcoin, which uses UTXOs, Ethereum calculates and stores the balance at the account level. Third, new smart contract accounts containing software code. 4. The result of the execution of smart contracts. In a prior lesson, we illustrated the hypothetical example of a streaming company counting the number of subscribers on the blockchain. In that example, at the end of the transaction fulfillment step, the new state of the blockchain would include the updated number of subscribers. We are now ready to move on to understanding some of the nuances that are specific to Ethereum in the transaction fulfillment step. But before we do that, we can note that the underlying steps are similar. After a transaction is authenticated, it is confirmed into blocks. Then the blocks are propagated to each node, which verify the blocks, and finally, each node forms a chain of blocks. While at a high level, the process taxonomy remains the same, there are Ethereum-specific nuances at each step. The rest of this lesson is devoted to understanding Ethereum-specific nuances in the transaction fulfillment step. I have listed them out here. We will cover each one. Transaction fee sufficiency. New coin issuance. Uncle blocks. Block gas limit. Proof of stake. Just as in Bitcoin, block creators are rewarded in two ways in Ethereum. Block rewards of newly minted Ether and transaction fees. In Ethereum, the complexity of the transaction varies and hence, the transaction fees can vary widely. To recap from the previous lesson, the transaction fees in Ethereum is derived by multiplying the number of gas units consumed in the transaction with the gas price. The number of gas units consumed is defined in Ethereum's design. It varies by the type of operations contained within the transaction. This parameter remains fixed until there is modification to the specifications agreed upon by Ethereum community. The gas price is derived from demand-supply factors, and if one quotes a very low gas price, miners may not pick the transaction. This is similar to Bitcoin. However, when it comes to gas units, the transaction initiator may not know how much gas will be consumed. Let us recap the three transaction types. For a simple payment transaction made to a currency address, the number of gas units required has historically been 21,000 units. The gas used for the deployment of a smart contract is not easy to predict. Similarly, for any transaction where the destination address is a smart contract, it is not always easy to estimate how much gas executing a contract will consume. To understand why, next we will go back to the Ethereum yellow paper. Let us go back to the Ethereum yellow paper. I will jump to page 27 where we have the gas fees schedule. Let us estimate the cost of deploying a contract. The operator code G create is 32,000 units. On top of it, we want the contract creation transaction to be included in the block. That costs 21,000 units as represented by G transaction. So far, we are at 53,000 units. There are also storage costs with longer codes requiring more gas units. This makes it difficult to estimate what the exact gas cost is going to be. A similar problem occurs while executing a contract. For example, if a contract calculates income tax, the computational power required will be higher if the calculation is being done for a person with multiple sources of income versus one source. To summarize, the cost of deploying and executing smart contracts can be difficult to estimate. For addressing this issue, Ethereum introduces a concept of gas limit. Gas limit is the maximum number of units of gas that the transaction processor is willing to pay. It is specified by the transaction processor. Next, we will dig deeper into how this works. Let us go back to our simple payment transaction on the Etherscan Block Explorer. I can see that the gas limit is 21,000 units. The actual gas utilized is 21,000 units. This payment was made via a wallet software that automatically populated the gas limit, since gas utilization of a simple payment transaction is well known. However, this field can be modified by the user, though not all wallet software may give this ability. In the example we just reviewed, the gas used was 21,000. The gas limit specified in the transaction also equal to 21,000. But what if the limit specified 20,000? My transaction will not be picked up by block creators. This is because the Ethereum virtual machine will use more gas than the gas limit in the transaction. What would happen if the limit specified was 25,000? Initially, the source Ether account will be debited by the higher transaction fees, but after processing, 4,000 units of gas and associated transaction fees would be refunded. But what if I didn't want to pay any fees at all? I could take my chances and quote the price per unit of gas to be zero. It may not be picked up by the miner at all, or might be picked up with a long lag at a time when network volume is very low. The real challenge with gas limit arises in smart contract transactions. Let us look into that issue next. Consider a scenario where a smart contract consists of 5 operations that occur sequentially. A transaction processor initiates a transaction that triggers execution of the contract. The gas limit specified in the transaction is 50,000 units. The first step consumes 20,000 units of gas. The second step consumes 10,000 units of gas. The third step consumes 20,000 units of gas. At this point, when the EVM proceeds to process the next step, it determines there is insufficient gas and produces an out-of-gas exception. But the transaction processor still has to pay the fees because the EVM already consumed 50,000 units. This is a loss to the transaction initiator because the contract didn't run, but she had to pay the fees anyway. To help prevent these issues, software developers can use Ethereum test environments as well as other applications, which help them accurately project gas limits. If they set a higher gas limit than what was utilized, they would eventually receive a refund. Developers may set a high limit as a signal to miners that their contract is sufficiently rewarding. We will now review the difference in the new coin issuance process between Bitcoin and Ethereum. In Bitcoin, the supply of Bitcoin exists purely through the Coinbase reward. In Ethereum, there are 2 sources. The first source is pre-mined Ether. These were 72 million Ether tokens issued through a crowd sale in 2014. The proceeds from the sale went to fund the development of the Ethereum platform. The second source is new issue of coins to reward ongoing transaction confirmation. This is similar to the Coinbase reward in Bitcoin. Another difference is in the total supply of currency. In Bitcoin, only 21 million can ever be mined. Also, the rate of issuance of new coins declines over time. In Ethereum, there is no lifetime cap. The maximum number of Ether tokens that can be awarded any year is capped at 25% of what was pre-mined. That amounts to 18 million. This can be changed, however, if the majority of the network users vote for a change. In 2022, Ethereum migrated from proof-of-work to proof-of-stake algorithm for block creation. We will learn more about proof-of-stake in the next lesson. In Ethereum's old proof-of-work mining system, discarded or stale blocks were rewarded with newly minted coins. In the proof-of-stake system, they get transaction fees. In Bitcoin, they don't receive any reward. In Ethereum, orphan blocks are called uncle blocks, or the more gender-neutral UMR blocks. This brings to the concept of uncle blocks. In the next section, we will deep dive into them. In a prior lesson on Bitcoin, we learned about stale blocks that are mined successfully but lose out to another block that was mined near simultaneously. In case you have forgotten the learnings from the Bitcoin lessons on mining, this is a good time to go back and review those lessons. Stale blocks are blocks that are perfectly valid but could not make it to the canonical chain as they were outcompeted by another block on account of a fork choice rule, like the longest chain rule. We are referring to the official blockchain record as the canonical chain. Such stale blocks, as we shall learn soon, are referred to as uncle or UMR blocks of the blocks in the canonical chain. Uncle blocks are descendants of the canonical chain because they refer to a parent block that is part of the canonical chain. In Bitcoin, stale blocks do not accrue any block reward or transaction fees. However, in Ethereum, miners of such blocks were rewarded new coins in the now retired proof-of-work mining system. Next, we will see how the reward system for such blocks worked. Even though the new proof-of-stake system rewards these blocks via fees instead of new issuance, it is helpful to learn how the old system worked. Our goal in this course is to develop a generalized understanding of blockchains, using Bitcoin and Ethereum as illustrative examples. Consider a canonical chain consisting of 8 blocks. The fork occurred at block 1, when block 2A was mined. This stale block can be referred to as an uncle block by a canonical block up to 6 blocks from the point the fork was created. In other words, block 3, 4, 5, 6, 7 and 8 can refer to block 2A as an uncle. When a block is referenced as an uncle by a canonical block, the transactions within the uncle block have no impact on the state of the blockchain. The uncle reference is purely informational. Any transaction in the uncle block that is not part of the canonical chain goes back to the mempool, just as in Bitcoin. In the old system, for referencing an uncle block, the canonical blocks received an inclusion award which was expressed as a fraction of what the winning miner would earn. The inclusion award could only be earned up to a distance of 6 blocks. In our example, only canonical blocks 3 to 8 could earn this reward. The reward for mining an uncle block to the miner was set on a sliding scale based on the distance from the referencing block, with the reward diminishing to 0 beyond the 6th block. To summarize, in Ethereum's old proof-of-work mining system, miners of canonical blocks got an inclusion award. Miners of the uncle block received a miner's award. The question is, why reward uncle blocks at all? The purpose is to incentivize a larger number of miners to perform the mining function. The greater the number of independent miners, spread across the globe, the greater is the probability that the rules of the blockchain will be adhered to. Imagine if there were only 10 miners in the system. 6 of them could form a majority and collude among themselves to attack the rules of the system for malicious reasons. This brings us to the concept of hash rate. Hash rate is a measure of the total computational capacity being deployed by all miners on a blockchain network. A higher hash rate makes it harder for malicious miners to attack the rules of the network. In the lesson on Bitcoin, we cover the term block size. In Bitcoin, the maximum block size is specified in terms of bytes of memory. Since all transactions in Bitcoin are payment transactions, the relationship between block size and number of transactions is stable. In Ethereum, the block size limit is defined in terms of the total number of gas units that can be consumed by transactions within a block. Hence, if there are many contract transactions that use large number of gas units, the number of transactions that can be included are fewer. In this lesson so far, we have covered 4 of the 5 points of difference in the transaction fulfillment step. We are still pending discussion of proof of stake. We will cover staking in the next lesson. Please review the summary of this lesson before proceeding to the next one.